What is up, everyone? It is your boy Imstar, AG, the Asian guy, and today we're going to talk about a number that might make you think I have completely lost my mind. We're going to talk about $650 silver, not 100, not 200, $650 per ounce by summer. Now I know what you're thinking. You are thinking that I have finally gone off the deep end. You are thinking that I have been stacking silver for so long that I have started hallucinating price targets. You're thinking that this is the kind of prediction that gets people laughed out of the room. And you know what? A year ago, I would have thought the same thing. A year ago, if someone told me silver was going to $100, I would have nodded politely and slowly backed away. But here we are. Silver has already surged more than 140% in the past year. We are trading in the mid-90s. We have touched $95. And suddenly, the predictions that seemed insane are starting to look like they might have been onto something. The silver squeeze wackos, the people who were mocked and ridiculed for years, the ones who kept saying the paper market was a fraud, the ones who kept stacking physical while everyone else chased crypto and meme stocks. They were right. About everything. And now some of them are saying $650. So today, I'm going to take that number seriously. I'm going to show you the math. I'm going to show you the supply dynamics. I'm going to show you the demand explosion. And then you can decide for yourself whether this is genius or madness. Let me start with the most compelling piece of evidence I have seen in months. And it does not come from some random analyst or social media influencer. It comes from the United States government. The US Mint has repriced their 2026 Silver Eagles, and the number they are charging is $173 per ounce. Let me say that again because I need you to understand how insane this is. The official United States Mint, the government agency responsible for producing the nation's coinage, is selling Silver Eagles at $173 per ounce. Meanwhile, the spot price of silver, the price that the paper markets say silver is worth, is trading around $95. That is a $78 gap. That is an 82% premium over spot at official government channels. This is not some coin dealer in a strip mall marking up their inventory. This is the United States Mint, the entity that actually produces the coins. And they are pricing silver at nearly double what the futures market says it is worth. Now, why would they do that? Why would the US Mint price their product at such a massive premium to spot? There are only a few possible explanations. Either they are trying to gouge their customers, which seems unlikely for a government agency, or they are anticipating costs and supply constraints that make the current spot price irrelevant. Or they know something about where physical silver availability is heading that the paper market has not yet priced in. I think it is the third option. I think the US Mint is seeing scarcity in their supply chain that is not yet reflected in COMEX futures. I think they are pricing for a reality that is coming, not the reality that currently exists. And if the US Mint thinks silver is worth $173, maybe the people predicting $650 are not as crazy as they sound. But let us dig into the fundamentals, because the price target means nothing without the analysis to back it up. The silver market is facing a structural crisis that has been building for years, and it is about to collide with a demand explosion that the world has never seen. Let us start with supply. Global silver production peaked in 2016. Let me repeat that. The peak was 8 years ago. Since then, annual output has been grinding lower at a rate of roughly 1 to 2% per year. The mines are not finding new deposits fast enough to replace what is being depleted. The easy silver has been found. The remaining deposits are deeper, lower grade, more expensive to extract. Data compiled by the Silver Institute confirms this trend. We are producing less silver every year while consuming more. This is the definition of a structural deficit. And unlike oil, where you can drill more wells when prices rise, silver does not respond quickly to price signals. New mines take years, sometimes decades, to develop. The permitting process alone can take 5 to 7 years. Then you have construction, equipment installation, workforce training. By the time a new mine is producing silver, the market conditions that justified the project may have completely changed. And here is the detail that makes this supply constraint even more severe. Many primary silver producers are already operating at thin margins. Silver is often produced as a byproduct of lead, zinc, and copper mining. The miners are not primarily chasing silver. They are chasing the base metals. This means silver production is not directly responsive to silver prices. Even if silver goes to $500, it does not necessarily mean more silver gets produced. The base metal economics have to justify the mining activity first. So we have declining production. We have long lead times for new supply. We have byproduct dynamics that limit price responsiveness. This is the supply side of the equation. And it is ugly. Now let us look at demand, because this is where the story gets truly explosive. Silver is not just a monetary metal. It is not just a store of value that competes with gold. Silver is an industrial metal that is essential to the technologies of the future. And those technologies are scaling faster than anyone predicted. Solar panels are the most obvious demand driver. Every solar cell requires silver for its electrical contacts. The photovoltaic industry is consuming over 120 million ounces of silver annually, and solar installations are growing exponentially. The world is building solar capacity at a pace that seemed impossible just a few years ago. India alone is building massive solar farms. China is covering deserts with panels. Europe is racing to reduce dependence on Russian energy. Every single one of those panels needs silver. Electric vehicles are the second major driver. EVs use silver in their battery connections, their electrical contacts, their charging infrastructure. The industry is projected to consume 70 to 75 million ounces of silver annually. And EV production is ramping up globally. Every major automaker is transitioning their lineup. Government mandates are accelerating the shift. The internal combustion engine is being phased out, and silver is essential to what replaces it. But here's where the demand story gets really interesting. We are now seeing entirely new categories of silver consumption emerge. Categories that did not exist 5 years ago. Categories that are about to explode. Artificial intelligence infrastructure requires silver. The data centers that power AI models, the servers that run ChatGPT and its competitors, the networking equipment that connects everything together, all of it uses silver. Silver has the highest electrical conductivity of any element. When you need to move electrons efficiently, when you need to minimize heat and maximize performance, you use silver. As AI scales, as more data centers come online, as the computational requirements grow exponentially, silver demand grows with it. Robotics is another emerging category. Every robotic joint, every electrical connection, every sensor interface requires silver. As robotics moves from factory floors to homes, as humanoid robots become reality, as automation spreads through every industry, silver consumption will surge. This is not speculative fantasy. Boston Dynamics is building robots right now. Tesla is building humanoid robots. The robotics revolution is happening, and it runs on silver. And then there are silver batteries. This is a technology that most people do not even know about. Silver oxide batteries offer superior energy density for certain applications. They are used in medical devices, military equipment, and specialty electronics. As battery technology advances, as new applications emerge, silver's role in energy storage could expand dramatically. Add all of this together: solar, EVs, AI infrastructure, robotics, advanced batteries, grid modernization, electronics, medical devices. The demand side of the silver equation is not just growing, it is exploding. And it is exploding at the exact same time that supply is declining. This is the setup for a violent price adjustment. When demand spikes and supply cannot respond, price is the only variable that can balance the equation. And when you're talking about a market as small as silver, the adjustment can be extreme. Let me put some numbers on this to show you how small the silver market really is. Total annual silver production is roughly 800 to 850 million ounces. At $95 per ounce, that is a market of about $80 billion per year. Compare that to gold at over $200 billion. Compare that to the oil market at trillions. Compare that to the stock market at tens of trillions. Silver is tiny. It is a minnow in the ocean of global commodities. This small size means that relatively modest inflows can move the price dramatically. When Indian retail investors decided to buy ahead of Diwali, they drained liquidity in London and sent prices to multi-decade highs. When Chinese banks ran out of silver products, premiums exploded globally. A few $billion of incremental demand in a market this size can cause massive dislocations. Now imagine what happens when AI companies decide they need to secure silver supply. Imagine what happens when Tesla announces they are stockpiling silver for robotics production. Imagine what happens when a sovereign wealth fund decides silver is a strategic asset. The capital that could flow into this market dwarfs the available supply. And when that capital arrives, the price discovery will be violent. This brings us to the analyst divide, because understanding the range of predictions tells you something important about where we are in this cycle. On one end, you have mainstream banks like UBS predicting silver will stabilize in the $42 to $47 range long term. On the other end, you have supply-driven models pointing toward $400 to $500 over the next cycle. And at the extreme, you have forecasts going to $650 and beyond. Wide dispersion in analyst predictions usually appears before structural repricing events. When the experts cannot agree, when the range of forecasts spans an order of magnitude, it means the market is in flux. It means the old models are breaking. It means something fundamental is changing that the consensus has not yet absorbed. Think about it this way. If everyone agreed that silver was going to $50, the market would already be at $50. Prices reflect consensus expectations. When you see radical disagreement, it means the market is pricing in uncertainty. And uncertainty, in a structurally tight market, usually resolves to the upside. The conservative analysts at UBS are looking at silver through a traditional lens. They are modeling historical relationships between silver, gold, interest rates, and the dollar. They are applying mean reversion frameworks that assume silver will return to historical norms. But what if the historical norms no longer apply? What if the demand drivers we are seeing are genuinely new? What if the supply constraints are more severe than their models assume? The analysts predicting $400 to $500 are looking at supply-demand models on a log scale. They are extrapolating structural deficits over time. They are assuming that if demand continues to grow while supply declines, price must eventually adjust to ration demand. This is basic economics. The question is not whether price adjusts, but when and how violently. And the analysts predicting $650? They are looking at the most extreme scenarios. They are modeling short squeeze dynamics where paper shorts are forced to cover against limited physical supply. They are modeling monetary crisis scenarios where silver re-monetizes as a medium of exchange. They are modeling supply disruptions from geopolitical events or resource nationalism. These are tail risk scenarios, but tail risks have a way of happening more often than models predict. Now let me talk about the short squeeze dynamics, because this is what could turn a gradual grind higher into an explosive spike. The silver futures market operates on leverage. Traders can control large notional positions with relatively small margin deposits. This creates a situation where open interest, the total number of outstanding contracts, can vastly exceed the physical silver available for delivery. If a significant number of long contract holders decide to take physical delivery rather than roll their positions, the shorts are in trouble. They have to acquire physical silver to deliver. But if the physical market is tight, if the vaults are depleted, if the premiums are already elevated, acquiring that silver becomes extremely expensive. This forces shorts to cover at higher prices, which pushes the price higher, which triggers more short covering, which pushes the price higher still. This is the squeeze dynamic. We are seeing early signs of this squeeze in the premium data. The US Mint pricing, Silver Eagles at $173 while spot is $95 is a premium signal. Turkish dealers paying $9 over spot is a premium signal. Indian refiners unable to meet demand despite doubling imports is a premium signal. These premiums are telling us that physical silver is worth more than the paper market says, and that gap cannot persist indefinitely. Let me also tell you about something happening on the supply side that most people are not paying attention to. New discoveries are still being made, and some of them are significant. A company called Sun Summit Minerals just reported drill results from their JD project in British Columbia. And the numbers are impressive. One drill hole returned 46 meters of gold-silver mineralization, averaging just over 1 gram per ton gold and nearly 45 grams per ton silver. Within that, they hit 6 meters that averaged over 5 grams gold and 158 grams per ton silver. And the kicker? A 1 meter interval that returned 784 grams per ton silver. That is almost 23 ounces of silver per ton of rock. These are the kinds of high-grade intercepts that get mining investors excited. But here is the important context. Even with discoveries like this, bringing new supply to market takes years. Sun Summit is planning a 10,000-meter drill program for 2026. They are expecting a mineral resource estimate by the second quarter of 2027. And then they would need to permit, finance, and build a mine. We are talking 5 to 7 years minimum before any of this silver reaches the market. So yes, there is silver in the ground. But the silver in the ground is not the same as the silver in your hand. The timeline for developing new mines means that even exciting discoveries do nothing to alleviate near-term supply constraints. The squeeze, if it happens, will happen before these new mines produce a single ounce. Now, let me address the skeptics, because I know there are people watching this who think $650 is absurd. They are looking at the chart and seeing a parabolic move that has already happened. They are saying silver is up 7x in 2025. They are saying it has already been a generational wealth event. They are saying there is no more room to move. I understand that perspective. Parabolic moves make people nervous. They make me nervous too. When an asset goes up 140% in a year, it feels like the easy gains are behind us. It feels like we are late. It feels like the top must be near. But here is what I want you to consider. Silver went from $4 to $50 in the 1970s. That was a 12x move. Silver went from $4 to $50 again in 2011. Another massive move. And in both cases, the moves happened because structural factors overwhelmed the paper market's ability to suppress price. Are we in a similar situation today? The supply constraints are arguably worse than either of those periods. The demand drivers are more diverse and more structural. The paper market leverage is higher. The physical tightness is more acute. If the conditions are more extreme, why would the price move be less extreme? I'm not saying $650 is guaranteed. I'm not saying it happens by summer. What I am saying is that dismissing it as impossible reflects a lack of imagination about what markets can do when fundamentals assert themselves. The people who said $100 silver was impossible are awfully quiet right now, Maybe the people saying 650 is impossible will be quiet in a year too. Let me also address the macroeconomic factors, because silver does not trade in a vacuum. Silver responds to real yields, dollar strength, and rate expectations. These factors are tracked through Federal Reserve data and can be monitored through the FRED database. Right now, the macro backdrop is supportive. The protectionist policies associated with the current U.S. administration have created uncertainty about the dollar's role in global trade. The attacks on the Federal Reserve have undermined confidence in monetary policy. Investors are increasingly looking for assets not denominated in U.S. dollars. The interplay between real and nominal yields matters for silver. When real yields are negative, when inflation exceeds the interest you earn on bonds, precious metals become more attractive. You're not giving up income to hold silver because the alternative investments are also losing purchasing power. This dynamic has been supportive for gold and silver over the past year. And then there's the generational shift happening among investors. Boomers, the wealthiest generation in history, are facing a problem. They have accumulated savings and financial assets that are being eroded by inflation. They are looking for ways to preserve purchasing power. Some of them are rediscovering precious metals. The phrase I keep hearing is that wealthy boomers are trying to avoid losing their life savings to inflation. And some of them are finding their way to silver. When you combine institutional demand from industries like solar and EVs, with retail demand from Asian stackers, with generational wealth preservation demand from aging boomers, you get a convergence of buying interest that the silver market has never seen. All of these buyers are competing for the same limited supply, and supply is not increasing fast enough to meet them. This is the setup. This is why serious people are talking about numbers that sound insane. $650 per ounce is not a random number pulled from the sky. It is the kind of price that could emerge if the short squeeze dynamics play out, if physical demand overwhelms paper supply, if the structural deficit asserts itself. Now, I want to give you my honest assessment because I owe you that. I do not know if silver goes to $650 by summer. Nobody knows that. Anyone who tells you they know the future is either lying or delusional. Markets are probabilistic, not deterministic. We can analyze the setup. We can understand the dynamics. But we cannot predict the outcome with certainty. What I can tell you is that the setup is as bullish as I have ever seen. The supply constraints are real. The demand drivers are real. The premium expansion is real. The U.S. Mint pricing silver eagles at $173 is real. These are not opinions. These are facts that you can verify. Whether this translates into $650 silver by summer depends on factors we cannot control. It depends on whether a short squeeze triggers. It depends on whether institutional capital flows into the space. It depends on whether physical demand continues to overwhelm supply. It depends on whether the paper market can continue to suppress price or whether it finally breaks. My advice is the same advice I always give. Position yourself for a range of outcomes. Do not bet everything on the most extreme scenario. But do not dismiss the extreme scenario as impossible either. The silver squeeze wackos were right about $100. Maybe they are right about what comes next too. Let me close with a thought about what it means to be early versus being wrong. For years, the silver stackers were mocked. They were called bugs. They were told they were missing the real gains in stocks and crypto. They were told silver was a dead asset with no future. And they kept stacking anyway. They kept buying physical. They kept holding. Now those same people are sitting on gains that exceed what most investors have made in their entire lives. They were not lucky. They were patient. They understood the fundamentals. They trusted the math. And they were willing to be early, to look wrong for years, because they knew that eventually the market would catch up to reality. That is the mindset you need in this market. You need to be willing to look crazy. You need to be willing to hold positions that the mainstream does not understand. You need to be willing to trust your own analysis, even when everyone is telling you that you are wrong. $650 silver might happen by summer. It might take longer. It might never happen at all. But the direction is clear. The trend is up. The fundamentals support higher prices. And the people who position themselves early are the ones who will benefit when the market finally prices in reality. This is Mr. AG Asian Guy, bringing you the analysis that asks the questions others will not ask. If this video made you think, if it challenged your assumptions, if it gave you a new perspective on what is possible, smash that subscribe button. Hit the notification bell. Drop a comment below telling me your silver price target. The wackos were right about 100. Will they be right about 650? Time will tell. But I know which side of that bet I am on. Stay sharp, stay stacking, and remember, AG is the way. See you in the next one.